The correlation between the presidential election and the stock market is intriguing. The S&P 500 is consistently surging in 2024, experiencing a remarkable upward trend. The QQM Growth ETF is also performing exceptionally well, particularly boosted by companies such as Nvidia, Tesla, Microsoft, and Apple taking the lead. Despite predictions of a potential recession this year due to high inflation and federal rates, the market is thriving unexpectedly. This raises suspicions about whether the market is being artificially propped up for political reasons during this election year. Historically, in presidential election years, the stock market tends to remain relatively stable or show positive trends, instilling confidence in American voters. However, the real test usually comes in the subsequent year. It's crucial to monitor the Consumer Price Index (CPI) and inflation data closely. Recent reports for June indicate favorable outcomes, which is a promising sign for the economy going forward.
Been continuing to track them this morning. They are higher after that June CPI data came in cooler than expected, declining actually 0.1% month over month. A rise of 0.1% was expected. Joining us now, we've got Tom Porcelli, who is the chief U.S.
He mentioned that while inflation has been decreasing, the recent Federal Reserve rate cuts are driven by factors beyond just inflation. What caught my attention was the subsequent discussion, delving into the potential implications of the upcoming presidential election on future Fed rate cuts. There are several significant points to consider here. Firstly, there's a possibility of a rate cut in July earlier than anticipated.
On the train to deflation, or is it too early to declare victory at this juncture? Tom, I'll go to you first.
Yeah, so good to be with you all. Look, I think that we are on the train to the Fed teeing up a cut. I think we were on that train before this number. But I think this number gives the Fed quite a bit of comfort. If you look at sort of some of the components, I get it, right? In so many ways, the shelter component is putting a floor underneath in inflation at large, and it behaved very sort of nicely this month. The thing that the Fed, one of the key reasons why the Fed even created this super core measure was to basically, in part, to remove the shelter component, because I think everyone sort of appreciates that it's just, there's some calculation issues there. So if you just look at headline CPI and you look at core CPI and you strip out shelter from both of those, you're now under 2%. You're running at a 1.8% pace. So I think the inflation fear that had been out there for so long, I think that the Fed is now, I think, moving beyond that, and I think the Fed is now really focused more on labor, which I would argue that they've actually been more focused on that for months. But I think Powell is now really sort of driving that home more out in the open. So I think with labor starting the process of slowing down, I think it's very reasonable to expect the Fed will start the process of removing some of those hikes a bit.
If this cut is announced, it could potentially trigger a positive response in the stock market, leading to a surge in market performance.
Optimal time to recalibrate monetary policy. I think there's been way too much attention being given to this first rate cut. What we're talking about is really recalibrating monetary policy to today's circumstances and tomorrow's outlook. I think Powell was clear in his testimony to Congress, saying that inflation is no longer the main risk and the only risk that we face. We are in an environment where you and I have discussed this in the past, where inflation has been cooling. The underlying drivers of disinflation remain firmly in place. We have slower consumer spending. We have weakening labor markets. We have an environment where pricing power has diminished and where pricing sensitivity has increased. These are all disinflationary. So these types of reports that we just saw this morning, where inflation continues to ease, is exactly the type of report that the Fed is looking for as we continue to move closer to the Fed's 2% target. I think now is really the time to reconsider whether we need as restrictive monetary policy as we've had for the past year, or whether it's time to gradually recalibrate and avoid exerting too much pain on the economy at this delicate juncture.
I mean, this delicate juncture as well, just to follow up on that, Greg, is really because we have a general election as well in November that places them in the scenario of, okay, if we're going to seem apolitical, do we have to get out ahead of that with enough time to be able to cut, or wait until the dust is settled and then initiate that first cut? I mean, what is the calculus you imagine that the Fed is navigating through, especially as they do run the risk of remaining too tight for too long because of that central event? that the political sphere is paying close attention to, and the markets too, to a certain extent.
An optics element to the Fed's decision when it comes to the elections, but I think the Fed is really keenly focused on ensuring that inflation moves down in a sustainable manner towards its 2% target. There are a few policymakers that are still leaning towards the hawkish side, are not likely to be in favor of any imminent rate cut. But I think gradually we're going to see Fed Chair Powell lead a core of Fed policymakers towards adopting a softer monetary policy stance, a less restrictive monetary policy stance, and recalibrate. The numbers in this report were very interesting because we have one of the key elements that has been supporting inflation, as Tom was saying earlier, which has been shelter cost inflation, which is now moderating quite significantly. And at the same time, you're seeing pockets of softness on the services sector side. Hotel prices falling 2.5%, airfares falling 5%. These are signs of consumers exercising more prudence and businesses having to adjust their pricing in this more prudent consumer spending environment. I think the Fed should take note of this increased consumer prudence and recount.
Secondly, despite reduced consumer spending and companies lowering prices in certain sectors, resulting in decreased profits, the stock market has continued its upward trajectory, defying expectations of a downturn. Thirdly, a crucial aspect is how the upcoming presidential election might influence future rate cuts. Politics could play a role in the timing of Federal Reserve rate adjustments around the election. While economic indicators may suggest readiness for a more relaxed monetary policy, rate cuts might be delayed until after the election for political expediency. In essence, the unpredictability of the situation necessitates preparedness. While one might expect a market correction given the circumstances, the anticipation of rate cuts could actually propel the market higher, signaling economic strength and a potential bull market. The market outlook post-rate cuts extending into 2025 and 2026 remains uncertain. While volatility and emotional responses might be expected post-election, overall market stability is projected. Fluctuations are likely, but the cooling inflation provides a positive backdrop for investment decisions. For further insights on navigating these market dynamics and enhancing your investment journey, feel free to explore the suggested videos for informed decision-making. Exploring the intricacies of market trends and economic forecasts is like deciphering a complex puzzle with ever-changing pieces. Each twist and turn in the financial landscape presents both challenges and opportunities for astute investors. By staying informed and adaptable, you can navigate these fluctuations with confidence, seizing moments of growth and fortifying your investment portfolio. Diving deep into the realm of investment strategies unveils a myriad of approaches tailored to different risk appetites and goals. From long-term value investing to agile day trading, the spectrum of tactics is vast and dynamic. Understanding your personal financial objectives and aligning them with the right strategy can pave the way for sustainable wealth accumulation and financial security. In the realm of finance, knowledge is power. Equipping yourself with insights, tools, and a keen understanding of market dynamics empowers you to make informed decisions that drive your financial success forward. By immersing yourself in educational resources, engaging with like-minded individuals, and continuously honing your skills, you position yourself as a formidable force in the ever-evolving world of finance. Stay ahead of the financial game. Subscribe to my channel now to unlock essential strategies and supercharge your path to financial success. Join a community of dedicated investors and fuel your